There was a house on Maple Grove Drive in Stockton, California, and in the summer of 2007, its front lawn had gone yellow. Before we go any further into this story, if you want a brand new American mystery every single night, subscribe. One tap and a new story is waiting for you every evening. The sprinklers had stopped running. The mailbox was stuffed full. A child's bicycle sat rusting against the porch railing. One wheel turned sideways, like it had just been dropped there and forgotten. The curtains were drawn. The neighbors had noticed, but nobody said much. It was easier not to. That house was not alone. All across Stockton, all across California, all across the country, lawns were going yellow. Curtains were staying closed. Families were packing what they could into the back of minivans and driving away from the houses they thought they owned. The moving trucks were busy. The foreclosure signs were going up like wildflowers after a hard rain, white and red, and impossible to ignore. Something was ending. Most people could feel it. They just didn't have a word for it yet. By the fall of 2008, they would. The number they kept hearing was $700 billion. That was the price tag. That was how much the United States government said it would cost to stop the whole thing from collapsing. $700 billion. And even that might not be enough. The men who said this wore good suits. They stood at podiums in Washington, D.C., and their voices were calm and measured, the way a doctor's voice gets calm when the news is very bad. They used words like systemic risk and liquidity crisis and too big to fail. What they meant was, the machine is broken, and we need you to fix it. The American people paid. Most of them had no choice. Now, here is where the story gets interesting. Not in a frightening way, but in the way that a locked room gets interesting when you realize the key was inside all along. Because in the years that followed, something strange happened. The banks that had caused the crash did not disappear. They did not shrink. They did not suffer the way the families on Maple Grove Drive had suffered. They grew. The biggest banks in America came out of the 2008 financial crisis larger than they had been going in. They absorbed the smaller banks that failed. They collected the pieces. They bought up the wreckage at low prices and built themselves taller on top of it. run those banks, the men who had built the instruments that caused the damage, most of them walked away clean. No handcuffs, no trials, no prison cells. Some of them got bonuses. People noticed this. Ordinary people, economists, journalists, former regulators, they all noticed. And some of them started asking a question that sounds almost too large to say out loud. What if this wasn't an accident? What if the crash of 2008 wasn't a failure of the system, but a feature of it? What if the chaos was useful to someone? What if the men at the top of the tallest buildings in New York and Washington knew something the rest of us didn't? What if the whole thing was, in some quiet and careful way, designed? Now, this story doesn't claim to have all the answers. No story does. But what this story has are facts and names and a trail of decisions that stretches back decades before that yellow lawn in Stockton ever went dry. It has phone calls and meetings and laws that were changed at exactly the right moment for exactly the right people. It has a pattern, and patterns have a way of meaning something. The old-timers who lived through the Great Depression used to say that money doesn't disappear. It just moves. When a man loses his savings, that money doesn't vanish into the air like smoke. It goes somewhere. It ends up in someone else's pocket. The question worth asking is always the same. Whose pocket? In 2008, somewhere between $8 and $10 trillion in American household wealth disappeared. Retirement accounts, home values, savings gone, like a tide going out. And somewhere in the same moment, other accounts were growing. Other positions were paying off. Other men were having very good years. The bicycle on the porch in Stockton is still rusting in someone's memory. The lawn is still yellow, and the question is still sitting there, patient as a stone, waiting for someone to pick it up and turn it over. Let's turn it over together. Before we get to the crash, we need to talk about the thing that crashed. Money. You carry it in your pocket. You swipe it on a screen. You trade hours of your life for it every week. But most people, if you pressed them, couldn't tell you what it actually is. Not really. And that confusion, that soft, comfortable fog most of us live inside, is exactly where this story begins. Picture a dollar bill. hold it in your mind. It's a small rectangle of green paper printed with old faces and Latin phrases and tiny numbers in the corners. It feels like something. It has weight. It has texture. The ink sits slightly raised on the surface, and if you run your thumb across it, you can feel the ridges. It smells faintly of copper and old hands. Thousands of people have touched that bill before you. But here's the thing. That paper isn't worth anything on its own. It's not backed by gold anymore. It hasn't been since 1971, when President Nixon quietly closed what they called the gold window. Before that, every dollar was supposed to represent a fixed amount of gold sitting in a vault somewhere. After that, it represented something harder to see. It represented trust, faith, a shared agreement between millions of people that this green rectangle means something. That's what money is. It's a promise, a collective story we all agree to believe. And like any story, someone has to be the one telling it. In America, that someone is the Federal Reserve. Most people think of it as a government agency. It isn't exactly. It's a private institution with a public function. It was created in 1913, born out of a secret meeting on a small island off the coast of Georgia called Jekyll Island. A handful of the most powerful bankers in the country gathered there in November of 1910. They arrived separately, using only first names, so no one would know they were meeting. They came by private railcar in the dark. They stayed for 9 days, and when they left, they had the rough outline of a plan that would become the Federal Reserve System. Think about that for a moment. The institution that controls the American money supply was designed in secret by bankers on an island. The Fed sets interest rates. That means it decides how expensive it is to borrow money. When rates are low, borrowing is cheap. People buy houses. Businesses expand. Money flows like a warm river through the whole economy. When rates are high, borrowing costs more. Things slow down. The river runs cold and shallow. This matters enormously for the story we're telling, because in the years leading up to 2008, the Fed kept rates very low for a very long time. Cheap money flooded the system. It had to go somewhere, and the people who knew how to direct that flood, the ones who understood the pipes and the valves and the hidden channels. Those people were in a position to get very, very rich. Now picture Wall Street, not the myth of it, the actual street. It's a narrow canyon in lower Manhattan, maybe a quarter-mile long. The buildings on either side rise so high that on a gray winter morning, the sky above looks like a thin white ribbon. The stone facades are carved with eagles and columns, and the names of men who died 100 years ago. The sidewalks are always wet. There's always wind. The air smells like exhaust and cold concrete and something metallic, like the inside of a machine. Inside those buildings, in the early 2000s, sat some of the most educated people in the country. Mathematicians, physicists, lawyers who had gone to law school and then gone back for more. They worked in glass offices with views of the harbor. They wore dark suits and carried phones that cost more than most people's monthly rent. They ate lunch at restaurants where the menu had no prices, and they were building something, not a product you could hold, not a factory or a bridge or a field of wheat. They were building instruments, financial instruments, complicated structures made entirely of paper and promises, layered on top of other promises, tied together with contracts that ran hundreds of pages long. Structures so complex that even the people building them sometimes couldn't explain exactly how they worked. But they all believed in the same thing. They believed the story would hold. They believed the promise would keep. They believed, the way you believe in the warmth of a fire, that the thing they were building could not fall. They were wrong. Every legend has its characters. Every story has its faces. And this one has a handful of men whose names you should know before we go any further. The first is Alan Greenspan. Picture a small, quiet man in a dark suit. He wore thick glasses that made his eyes look larger than they were. He spoke slowly, in long sentences that seemed to fold back on themselves, like a river that couldn't decide which way to run. He had been the chairman of the Federal Reserve since 1987. That's nearly 2 decades of sitting at the center of American money. He believed deeply and completely that markets could take care of themselves, that if you left them alone, they would find their own balance. He said this in speeches. He said it in testimony before Congress. He said it so many times that people stopped questioning it. It became the air everyone breathed. Then there is Robert Rubin. He came from Goldman Sachs, one of the oldest and most powerful investment banks on Wall Street. He had the easy confidence of a man who had never lost a bet he couldn't afford to lose. He became Treasury Secretary under Bill Clinton in 1995. He wore his power quietly, the way a river wears its banks. He didn't shout. He didn't need to. The people in the room already knew who he was. Rubin believed in deregulation. He believed that the old rules were holding American finance back, and he had the ear of the president. Alongside Rubin stood Larry Summers. Summers was younger, louder, and faster. He had the energy of a man who had been the smartest person in every room since childhood and had never quite gotten used to the idea that others might disagree. He was an economist from Harvard. He had the kind of credentials that made senators sit up straight. When Rubin left Treasury, Summers took the chair. The philosophy stayed the same. The direction stayed the same. Only the face at the table changed. There was also Phil Gramm, a senator from Texas with a sharp jaw and a sharper tongue. He had been an economics professor before he went into politics, and he never let you forget it. Graham believed that government had no business telling banks what they could and couldn't do. He pushed legislation. He wrote bills. He worked the phones and the back rooms with the patience of a man who knew exactly what he wanted and was willing to wait for it. His name would end up on one of the most important pieces of financial law in American history. We'll get to that. And then there is Sandy Weill. Weill built Citigroup into something that had never existed before. He was a stocky man with a big cigar and a bigger appetite. He grew up in Brooklyn. He started small. He bought companies the way some men collect baseball cards, one after another, stacking them up until he had something enormous. By the late 1990s, Citigroup was the largest financial institution in the world. It was a bank. It was an investment firm. It was an insurance company. It was all of those things at once, under one roof, sharing one balance sheet. The old laws said you couldn't do that. Weill did it anyway. he lobbied to change the laws so that what he had done became legal. These men were not villains in the old storybook sense. They didn't twirl mustaches. They didn't cackle in dark rooms. They were true believers. They thought they were building something great. They thought they were making American finance stronger, faster, more powerful. They looked at the old rules and saw chains. They looked at deregulation and saw wings. That's what makes this story strange. The most dangerous thing isn't a man who wants to do harm. It's a man who is absolutely certain he's doing good. These 5 men and a handful of others who moved in the same circles, attended the same dinners, sat on the same boards, and shared the same ideas. They built the machine. They laid the track. They wrote the rules that removed the old rules. They opened the doors that the previous generation had closed on purpose, after hard lessons, after real pain. They were brilliant. They were connected. They were confident in a way that left no room for doubt. And somewhere behind all of them, quiet and patient, were the institutions they served. The banks, the firms, the names on the tall buildings in Lower Manhattan. Those names matter too. But first, you have to understand the wall that stood between you and them. And what happened when someone finally decided to tear it down. Picture a small bank in 1955. Maybe it's in Ohio. Maybe it's in Georgia. It doesn't matter much. What matters is what it looks like inside. The floors are polished marble, cool and pale as winter light. The teller windows are brass and frosted glass. The ceiling is high enough that your voice gets a little lost up there. And behind the counter, a man in a pressed shirt knows your name. He knows your father's name. He knows what you do for work and whether you're good for a loan. That bank took your deposits. It kept them safe. And when someone in town needed money to buy a house or start a business, the bank lent it out. Simple as that. The bank had every reason to make sure you could pay it back. If you couldn't, the bank felt it. The bank suffered. So the bank was careful. The bank knew you. That was the whole system. This is the world that Glass-Steagall built. In 1933, the country was still shaking from the Great Depression. Banks had failed by the thousands. Ordinary people had lost everything. Congress passed the Glass-Steagall Act to to make sure it couldn't happen again. The law drew a hard line. Commercial banks, the ones that held your savings and gave out loans, had to stay completely separate from investment banks, the ones that gambled on stocks and bonds and the big swings of the market. You could do one or the other, not both, never both. The men who wrote that law understood something simple. When a bank holds your savings and also bets on the market, it's playing with your money. And if the bet goes bad, you're the one who loses. The wall between commercial and investment banking wasn't just a rule. It was a promise. It said, your money is not a chip on a table. It is yours. For 66 years, that wall held. Banks stayed in their lanes. Savings banks were boring. Investment banks were wild. And because they were separate, when an investment bank blew up, it didn't take your savings account with it. The system had a kind of natural fire break built right into it. Now, you have to understand something about walls. People who want to get past them don't usually attack them head-on. They chip away. Slowly, quietly, they find the small exceptions. They ask for little favors. They argue that the rules are old and the world has changed. And over time, the wall gets thinner and thinner until one day you lean against it and it just falls. By the 1980s, the chipping had already begun. Banks were growing restless. The investment side of the business was making enormous money. Commercial banks wanted in. They hired lobbyists. They made arguments. They said the old rules were holding America back. They said foreign banks didn't have these restrictions. They said the market had evolved. The Federal Reserve started granting exceptions. Small ones at first. A bank could do a little of this, a little of that. The line blurred. Then it blurred some more. Each exception made the next one easier to ask for. By the 1990s, the wall was barely standing. Then came 1999. A man named Phil Gramm, a senator from Texas, put his name on a bill. Robert Rubin, who had run Goldman Sachs before becoming Treasury Secretary, helped push it through. President Clinton signed it on a November afternoon. The bill was called the Gramm-Leach-Bliley Act. Most people have never heard of it, but it finished what decades of chipping had started. It tore down the wall for good. Glass-Steagall was gone. The men who celebrated that day called it progress. They called it modernization. They said the old rules were relics of a more fearful time. They said the markets were smarter now. They said the banks could be trusted to manage their own risks. And for a few years, it looked like they might be right. The economy hummed. The stock market climbed. Banks got bigger. Mergers happened. Names you'd known your whole life swallowed up other names you'd known your whole life. The marble floors and the brass teller windows started to disappear. Branches closed. Faces you recognized were replaced by automated systems and 1-800 numbers. The small bank in Ohio, the one with the cool marble floors, and the man who knew your father's name. It got bought, and then the thing that bought it got bought, and the thing that got bought again. And somewhere in all that buying and selling and merging and growing, the promise got lost. The fire break was gone. The wall was rubble. And nobody was watching what happened next. Somewhere in the middle of all this, a door opened that was never supposed to open. Not in a boardroom, not in Washington, in a small house on a quiet street in a town you've probably never heard of. The yard had a chain link fence. There was a car in the driveway that needed new tires. And one afternoon, a man in a pressed shirt knocked on the front door and told the family inside that they could own this house. All of it, no money down. No proof of income required. Just sign here and here and here. The family signed. They didn't know what they were signing. Not really. The papers were thick and the words were long. And the man in the pressed shirt smiled the whole time. He had done this before. He would do it again tomorrow in another town, at another door. He wasn't a villain in his own story. He was just a man trying to make his numbers for the month. But the loan he handed that family was something strange. Something that hadn't really existed before. People in the industry had a name for it. They called it a ninja loan. No income, no job, no assets. And somehow, a bank had agreed to lend this family $200,000 anyway. The monthly payments started low, soft and easy, like the first warm days of spring. For 2 years, the family paid without trouble. They painted the kitchen. They planted something in the yard. They started to believe the house was really theirs. Then the payments changed. That was always part of the deal, buried deep in the paperwork. The loan had what they called an adjustable rate. After a set period, the interest would reset. The monthly payment would climb. Sometimes it would double, sometimes more. The man in the pressed shirt had mentioned this briefly, somewhere in the middle of a long conversation. He had not dwelled on it. The family hadn't dwelled on it either. This kind of loan had a name too. An ARM, an adjustable rate mortgage. And in the early years of the 2000s, they were spreading across the country like seeds carried on the wind. Banks were handing them out in neighborhoods where they had never lent before, to people who had never owned anything, to people whose credit scores were low, and whose savings were thin, and whose whole financial lives existed on the edge of a very narrow ledge. The banks called these borrowers subprime. It was a clean, clinical word. It meant, in plain language, that these were people who probably couldn't pay the money back, and the banks lent to them anyway. Here is the part that doesn't make sense at first. A bank that lends money, it never gets back, loses money. That's how it's supposed to work. A bad loan is a bank's problem. So, why would a bank make a loan it expected to fail? Unless the bank didn't plan to keep the loan. That's the strange thing. The small sound in the wrong place. The light flickering where no light should be. These mortgages, millions of them, were never meant to sit on a bank's books. The moment the ink dried on that family's paperwork, the clock was already ticking. The loan would be sold quickly to someone else, and then sold again, and bundled with hundreds of other loans just like it, and sold again after that. By the time the family's payments started rising, the original bank was long gone from the picture. The loan had passed through so many hands that nobody could say with certainty who owned it anymore. It had been sliced and packaged and repackaged into something that barely resembled a mortgage at all. The family didn't know any of this. They just knew the payment had gone up. They knew the number on the bill was bigger than the number in their account. They knew the spring had ended and something colder was coming. Across the country, in hundreds of towns just like theirs, other families were opening the same kind of mail. Other doors were going quiet. Other yards were going untended. The chain link fences stayed. The cars stayed. But the families started to disappear, one by one, like candles going out in a long, dark hallway. Nobody in a position of power said anything yet. The men in the tall buildings were still smiling. The numbers on the screens were still climbing. The party was still going, and the music was still loud. But somewhere underneath all of it, something had already started to crack. Quiet and slow, the way ice cracks in late winter. You don't hear it until you're already standing on it. Picture a small town diner somewhere in Ohio. Maybe 2004. Maybe 2005. The coffee is burnt and the pie is good, and two men are sitting in a corner booth talking about something that doesn't quite make sense to either of them. One of them works at a local bank. The other one sells insurance. They've been neighbors for 20 years, and the banker is trying to explain something he heard at a conference last month. Something about loans being bundled together and sold off to investors far away. Something about how the risk just kind of disappears. The insurance man stirs his coffee. He says that doesn't sound right. The banker agrees, but he shrugs. Because the people doing it are very smart, and they wear very good suits, and the numbers on paper look clean. That's the thing about what happened next. It didn't look like poison. It looked like medicine. It looked like progress. It looked like the smartest people in the world had finally figured out how to make money grow without anyone getting hurt. Here's what they actually did. The banks were handing out mortgages to people who couldn't afford them. You know this part now. But a mortgage sitting on a bank's books is a risk. If the borrower stops paying, the bank takes the loss. So the banks needed a way to make that risk go away. They found one. They took thousands of those mortgages and bundled them together into a single package. One big brick of debt. They called it a mortgage-backed security. The idea was that even if some borrowers stopped paying, the rest would keep going. The risk was spread thin, diluted, like a drop of something bitter dissolved into a whole swimming pool. Then they sold that brick to investors. Pension funds, insurance companies, foreign banks, anybody with money looking for a safe place to put it. And for a while, it worked. The payments came in. The investors got their returns. Everybody smiled. But the banks didn't stop there. They took those mortgage-backed securities and bundled them again. They stacked bricks on top of bricks. They sliced the pile into layers and gave each layer a name. The top layer was supposed to be the safest. The bottom layer carried the most risk. They called these new structures collateralized debt obligations, CDOs, a word that sounds like it belongs in a laboratory, not a living room. The people who bought them didn't always understand what was inside. They trusted the name on the box. They trusted the men in the good suits who explained it with charts and confidence, and the kind of calm that money tends to produce. Back in that Ohio diner, the insurance man has a cousin in Cleveland who just bought a house. No money down. No proof of income required. The bank told him not to worry about it. Told him the house would be worth more next year. Told him he could refinance before the payments got too big. The insurance man thinks about this. He thinks about his own father, who saved for 11 years before he bought a house, who sat across a desk from a loan officer who looked him in the eye and asked hard questions, who signed papers he understood. Something feels different now. He can't name it exactly, but it feels like the rules changed when nobody was looking. He's right. They did. The old-timers in towns like his had a saying. They said you can't sell a bad apple by putting it in a pretty basket. But that's almost exactly what was happening. The bad apples were being sorted and stacked and wrapped in cellophane and labeled organic. And the people buying them were buying them by the truckload. The men who built these structures weren't hiding in the shadows. They were on television. They were in magazines. They were giving speeches at universities about the genius of modern finance. They had names for everything. They had models. They had formulas that could tell you, down to the decimal point, exactly how safe something was. The formulas assumed that housing prices would always go up. That was the foundation of all of it. That single quiet assumption, buried deep inside the math, holding everything else up like a wooden post in wet ground. Nobody asked what happened if the post rotted. or maybe some people asked. But the music was loud, and the money was good, and the men in the good suits smiled their calm, expensive smiles and said not to worry. The coffee in that Ohio diner went cold. The two men paid their bill and went home, and the bricks kept stacking. To understand what happened in 2008, you have to go back much further than 2008. You have to go back to a small room in Lower Manhattan, sometime in the 1850s. The air smells like coal smoke and river water. Men in wool coats are trying to figure out something simple. They want to know if a company is worth lending money to. They want a number, a grade, something clean and easy they can hold in their hand. That desire, the desire for certainty in an uncertain world, is where this story really begins. A man named Henry Varnum Poor started publishing financial reports on railroad companies in 1860. He wanted to give investors honest information about where their money was going. His idea was pure. His intention was good. He believed that sunlight was the best disinfectant, that if people just had the right information, they would make the right choices. His company eventually became Standard and Poor's. You know it today as S, and P. John Moody came along in 1909 and started rating railroad bonds using a simple letter system. AAA meant safe. AA meant pretty safe. The letters went down from there, all the way to the ones that meant stay away. Moody's became a name people trusted the way they trusted a doctor or a judge. The grade meant something. It carried weight. For decades, the system worked the way it was supposed to work. Rating agencies were paid by investors, the people who needed honest information. That's an important detail. The people paying for the grade were the people who needed the grade to be true. Their money was on the line. Their retirement, their savings. They needed the truth. Then something shifted. In the 1970s, the model changed. Rating agencies stopped charging investors and started charging the companies that wanted to be rated. Think about that slowly. The companies that needed a good grade were now the ones paying for the grade. The fox moved into the henhouse, and nobody rang a bell. For a while, even that worked well enough. The companies being rated were real companies with real assets, factories, railroads, office buildings, things you could touch, things that had value you could measure. But by the early 2000s, the things being rated had changed completely. The products coming across the desks at Moody's and S and P and Fitch were no longer simple. They were those bundled mortgage packages from the last section. Those towers of loans stacked on top of each other like a house of cards in a windstorm. The analysts at the rating agencies were supposed to look at those towers and tell the world how solid they were. The problem was that nobody really knew how to measure them. The math was new. The models were untested, and the banks that built those towers were paying the agencies to grade them. If an agency gave a bundle a low grade, the bank would take its business to a competitor. The agencies knew this. They felt it the way you feel a cold wind through a thin coat. So the grades crept upward. AAA ratings went out the door on products that deserved something far closer to the bottom of the alphabet. There's a phrase that floated around inside those agencies during those years. Some of the analysts used it quietly between themselves in emails that would later become evidence. They called it ratings shopping. A bank would go from agency to agency, showing its product, until it found the one willing to give it the grade it wanted. One analyst at S and P wrote in an email that a deal could be structured by cows, and they would still rate it. That email was sent in 2006, 2 years before everything collapsed. The people inside those buildings knew. Some of them said so in writing, and then kept working anyway. The money was good. The business was booming. The whole machine was humming so loud, it was easy to tell yourself the hum meant health. This is the older pattern. It goes back further than the 1970s. It goes back to every moment in American history when the people paid to tell the truth had a reason to lie. The railroad barons of the 1800s had their friendly auditors. The robber barons of the Gilded Age had their cooperative newspapers. Every great consolidation of power in this country has had its gatekeepers, the ones who were supposed to warn the public and instead waved the public through. The rating agencies in 2008 were not a new invention. They were an old story wearing a new suit. and the grade they gave to garbage was AAA. There was a man in San Jose who couldn't sleep. His name was Michael Burry. He was a doctor who became a money manager. He wore shorts and a t-shirt to work. He had a glass eye, and he listened to heavy metal alone in his office. He was not the kind of man you'd picture on Wall Street. That was probably why he saw what everyone else missed. Burry had a habit. He read things, not headlines, not summaries, the actual documents, the full contracts, the fine print that nobody wanted to sit with long enough to understand. In 2004 and 2005, he started reading mortgage bonds, hundreds of them, thousands of pages of dense legal language that most professionals skimmed or skipped entirely. What he found made him go very still. The loans inside these bonds were rotten. Not a few of them, most of them. Borrowers with no income, no assets, no way to pay. Adjustable rates set to jump in 2 or 3 years. Loans that looked fine on paper today and would collapse like wet cardboard the moment those rates reset. Burry ran the numbers again and again. The answer kept coming back the same. This whole thing was going to fall apart. Now here is where the story gets strange. Burry didn't just figure this out and warn people. He didn't write a letter to a newspaper or call a senator. He did something else entirely. He went to the big banks and he asked them to build him a product that didn't exist yet. A way to bet that the mortgage market would fail. A financial instrument called a credit default swap. Basically, it was insurance on a bond. If the bond failed, Burry got paid. If it didn't fail, he paid a premium every single month until it did. The banks loved this idea. They thought he was out of his mind. They took his money gladly. Goldman Sachs took his money. Deutsche Bank took his money. Morgan Stanley took his money. They were on the other side of his bet. They were so sure the housing market would keep rising that they couldn't sign the paperwork fast enough. They thought they were taking candy from a man in a t-shirt who listened to Metallica. Burry bet over $1 billion that the American housing market would collapse. He wasn't alone, though he didn't know it yet. Across the country, in quiet offices, and on high floors with views of the Hudson River, A small number of other people had found the same crack in the wall. A trader named Steve Eisman, a small fund called Cornwall Capital, run by two men working out of a converted shed. A few others scattered here and there, each one reading the same documents, running the same numbers, arriving at the same cold conclusion. None of them knew each other. None of them were coordinating. They had each just followed the paper trail far enough to see what was at the end of it. And what was at the end of it was this: the banks that had built these bonds, packaged them, sold them, and collected their fees, were now also betting against them. Some of the very same institutions that had sold mortgage bonds to pension funds and retirement accounts, and foreign governments were quietly taking out their own insurance, their own credit default swaps, their own quiet bets that the thing they had just sold you would fail. Let that image sit for a moment. A man sells you a car. He shakes your hand. He waves as you drive away. And then he walks back inside and bets his friends that your brakes are going to give out before you reach the highway. That is what some of these banks were doing. Goldman Sachs would later become the most famous example. They had sold mortgage bonds to clients, and then they had hedged, quietly, internally. They had positioned themselves to profit when those bonds lost their value. The clients didn't know. The public didn't know. The regulators, if they knew, said nothing. Burry's fund started losing money in 2006 because the collapse hadn't happened yet. His investors panicked. They called him. They demanded he close the positions. He refused. He had done the math. He knew what was coming. He just didn't know exactly when. He sat in his office in San Jose with his heavy metal and his glass eye and his mountains of paper. And he waited. Outside his window, the California sun was warm and golden. The housing market was still rising. Everybody on television was still smiling. But the clock was already running. Here is the thing about a storm. Before it arrives, certain people feel it. Not in the news, not in a report, in their bones, in the way the air changes, in a feeling they can't name but can't shake either. The crash of 2008 was like that. And the witnesses were everywhere. There was a woman in Phoenix named Sandra. she sold real estate. She'd been selling homes in the desert sun for 15 years, and she knew the rhythm of it, the slow seasons, the busy ones, the way a neighborhood felt when it was healthy. By 2006, something felt wrong to her. She couldn't say exactly what, but the buyers coming through her open houses were different. Young couples with no savings. People who winced when she asked about down payments. She'd write up the paperwork and think quietly to herself, how are they going to pay this back? Nobody asked her that question. Nobody wanted to hear it. She kept selling houses because that was her job. But at night, she'd lie awake in her own home, the desert air dry and still outside her window, and she'd feel a low hum of dread she couldn't explain to her husband. She just knew. The way you know when fruit has gone one day past ripe. You can't see it yet, but you can smell it. There was a man named Richard who worked at a mid-sized bank in Ohio. He processed mortgage applications. He sat at a desk under fluorescent lights, surrounded by the soft sound of keyboards and ringing phones. And every day the files on his desk got stranger. Income stated, but not verified. Assets listed, but never checked. He started keeping a private count of the applications he thought would default within 2 years. By the end of 2006, it was more than half. He brought it up to his manager once. Just once. His manager smiled and told him the models had it covered. Richard went back to his desk. He didn't bring it up again, but he moved his own savings into something safer. He told his wife they should wait before buying a bigger house. She thought he was being overly cautious. He didn't know how to explain what he'd seen in those files, so he just said, "Not yet. Let's wait." There was a professor in Boston who taught economics to undergraduates. She'd been watching the housing numbers for 2 years with a growing unease. The prices didn't match the incomes. The debt didn't match the assets. She wrote a paper in 2006 that laid it out plainly. She sent it to 3 journals. 2 rejected it without comment. 1 published it in a small quarterly that almost nobody read. She gave a talk at a conference and watched the audience politely check their phones. After the talk, one older economist came up to her and said quietly, "You're right, you know." Then he walked away. she never saw him again. There was a trader in New York, young, maybe 28, who sat on a floor full of screens and noise, and the constant smell of bad coffee. He noticed something in the data that didn't add up. The spreads on certain mortgage-backed securities were moving in a way that suggested someone, somewhere, was quietly getting out. Not loudly, not in a way that would cause alarm, just a slow, steady exit, like someone leaving a party early because they know something the other guests don't. He mentioned it to a colleague. His colleague shrugged. "The numbers are the numbers," he said. "The party keeps going until it doesn't. That's the part that stays with you when you hear these stories. It wasn't that nobody saw it. It's that the people who saw it had no power to stop it. They were scattered. They were alone with their knowing. A woman in Phoenix lying awake in the dark. A man in Ohio keeping a private count. A professor talking to an empty room. A young trader watching a slow, quiet exit that nobody else seemed to notice. They all saw the same thing. They saw it from different windows, in different cities, with different words for it. But the shape of what they saw was the same. Something was wrong. Something had been wrong for a long time, and the machine was still running, still humming, still producing paper that looked like wealth and felt like nothing at all. The storm was already there. It had been there for years. Most people just hadn't looked up at the sky yet. There's a moment in any good mystery when the scattered pieces stop looking like noise. They start looking like a pattern. You've been staring at separate things, a bad loan here, a crooked rating there, a quiet bet placed against a bond nobody was supposed to know about. And then something shifts. The picture comes into focus, and you realize the pieces were never scattered at all. That moment in this story is the names. Pull back far enough and you start to see them. The same names, the same firms, the same faces appearing at the same tables, in the same rooms, at the same critical moments. Not once, not twice, over and over again, like a chord that keeps resolving to the same note, no matter what song you're playing. Start with Hank Paulson. He ran Goldman Sachs from 1999 to 2006. He turned it into one of the most powerful financial institutions on earth. Then, in the summer of 2006, he left to become Secretary of the Treasury under President George W. Bush. He walked straight from the top of Wall Street into the top of Washington. No cooling off period. No distance. He arrived in the capital just as the mortgage market was beginning to crack at its edges. Then there's Robert Rubin. He ran Goldman Sachs before Paulson. Then he became Treasury Secretary under Bill Clinton. Then he left Washington and went to Citigroup, one of the biggest banks in the country, where he collected somewhere around $115 million over the following decade. Citigroup was one of the banks that would later need a government rescue. Rubin was on its board the whole time. Timothy Geithner never ran a big bank, but he ran the Federal Reserve Bank of New York, which is the branch of the Fed that sits closest to Wall Street. He was in that chair from 2003 to 2008. Those were the years the machine was running hottest. When the crisis hit, he became one of the key architects of the government response. Then, when Obama took office, he became Treasury Secretary. The baton passed again. These are not accusations. These are just the facts of where these men stood and when they stood there. But the pattern doesn't stop with individuals. It runs through institutions too. Goldman Sachs alone placed people at the top of the New York Fed, the Treasury Department, the World Bank, and the European Central Bank. Critics started calling it Government Sachs, not as a compliment. The revolving door between Wall Street and Washington had been spinning for decades. But in the years leading up to 2008, it was spinning faster than ever. The people who wrote the rules had come from the firms those rules were meant to govern. Some of them would return to those firms when their government service ended. The line between regulator and regulated had gone soft and blurry, like a photograph taken in bad light. And here is where the pattern gets harder to dismiss. When the crisis finally broke open, the men called in to manage it were the same men who had been present while it was building. Paulson was at the Treasury. Geithner was at the New York Fed. Ben Bernanke was at the Federal Reserve. These were not outsiders brought in to clean up a mess. These were insiders who had watched the mess accumulate. The decisions they made in those weeks and months were enormous. which firms got saved, which ones didn't, who got capital injections and who got nothing. The amounts involved were staggering, and the men making those calls had deep, long, personal relationships with the firms on the receiving end. You can believe that's a coincidence. Plenty of people do. They'll tell you these were simply the most qualified people available. That expertise has to come from somewhere. That you can't manage a financial crisis without people who understand finance. That's a fair argument. It deserves to be heard. But there's another way to read the same set of facts, and that reading goes like this. The people who built the system, who loosened the rules, who let the pressure build to dangerous levels, were the same people handed the tools to release that pressure when it finally blew. They got to decide who was saved. They got to decide the terms. They got to decide what the public would be told and how. The same names, the same rooms, the same hands on the wheel at every turn. Patterns don't prove anything by themselves, but they do ask questions. And the question this one asks is quiet and simple and hard to shake once it settles into you. Who exactly were they working for? Bear Stearns had been around for 85 years. It had survived the Great Depression. It had survived Black Monday in 1987, when the stock market lost nearly a quarter of its value in a single afternoon. It had survived every panic and crash and crisis that the 20th century could throw at it. The building at 383 Madison Avenue stood 47 stories tall, all glass and steel, catching the morning light over Midtown Manhattan like a mirror held up to the sky. And then, on a Sunday in March of 2008, it was gone. Not gone like a building burns down. Gone like a name gets erased. Gone like someone took a pen and crossed it out. Here is how it happened, the way people have told it ever since. By early March of 2008, the rumors were already moving through the markets like smoke under a door. Bear Stearns had been bleeding for months. 2 of its hedge funds had collapsed the previous summer. The ones stuffed full of those mortgage-backed securities that nobody could actually value anymore. The firm had written down billions. Its stock had fallen, but it was still standing, still open, still trading. Then the whispers started. Bear Stearns was in trouble, real trouble, the kind you don't come back from. In this world, a rumor is a weapon. When people believe a bank is failing, they pull their money out. When they pull their money out, the bank actually fails. The rumor makes itself true. And someone, somewhere, was whispering very loudly. By the morning of Thursday, March 13th, the firm's cash reserves had fallen to nearly nothing. Bear Stearns had started that week with about $18 billion in liquid assets. By Thursday morning, that number had dropped to somewhere around $2 billion. In 4 days, the money had simply walked out the door, one wire transfer at a time. That Thursday night, the calls went out. Bear Stearns reached out to the Federal Reserve Bank of New York. They reached out to J.P. Morgan Chase, which served as their clearing bank. The message was simple and terrible. We will not open tomorrow unless someone helps us tonight. The Fed moved fast. By Friday morning, they had arranged an emergency credit line routed through J.P. Morgan to keep Bear Stearns alive for one more day. Just one more day. Just enough time to find a buyer over the weekend. That Friday, Bear Stearns stock fell nearly 50%. The building on Madison Avenue was still standing. The lights were still on. But everyone who worked there knew something had broken that couldn't be fixed. The weekend that followed was the kind of weekend that gets written about in books. Teams of lawyers and bankers and government officials moved through conference rooms, drinking cold coffee, staring at spreadsheets, trying to put a price on something that was falling apart as they watched. The Fed made clear that a disorderly collapse of Bear Stearns was not acceptable. The firm was too connected to everything else. Its failure, left alone, might pull other firms down with it. J.P. Morgan Chase was the buyer. The price they agreed on was $2 a share. $2. Bear Stearns stock had traded at over $170 a share just 12 months before. The firm had buildings, assets, thousands of employees, decades of history. And the price was $2 a share. The Fed agreed to back the deal with $29 billion in financing. They would take on the riskiest assets, the ones nobody wanted to touch. J.P. Morgan got the rest. The announcement came on a Sunday morning, March 16th. The markets were closed. Most of America was still asleep or sitting at a kitchen table with a cup of coffee, reading the paper, thinking about the week ahead. And here is the part that people keep coming back to. Here is the detail that sits in the back of the mind and won't quite leave. J.P. Morgan Chase was the clearing bank for Bear Stearns. That means J.P. Morgan already knew in real time exactly how fast the money was leaving. They watched the reserves drain down to nothing. They had a front row seat to the collapse before anyone else did. And they were also the buyer. The firm that watched it fall was the same firm that bought it for $2 a share, backed by $29 billion in government money. People who study this moment say it was a rescue, a necessary intervention to stop a panic from spreading. Other people look at those same facts and see something different. They see a firm that was positioned perfectly. They see a price that made no sense. They see a Sunday morning announcement and wonder who already knew what was coming. Here is something that doesn't fit neatly into any explanation. In the days before Bear Stearns collapsed, before the Sunday morning phone calls and the emergency meetings and the handshakes that moved billions of dollars, something else was happening. Something quieter. Something that left almost no paper trail. Options contracts were being bought. Lots of them. An options contract is a bet. A very specific kind of bet. You pay a small amount of money now for the right to sell a stock at today's price sometime in the future. If the stock falls, you win big. If the stock stays the same or goes up, you lose the small amount you paid. It's a way of saying, without saying it out loud, that you believe something bad is about to happen. In the weeks before Bear Stearns fell, someone bought an enormous number of put options on Bear Stearns stock. Put options are the kind that pay out when a stock drops. The volume was unusual. Analysts noticed it later when they went back through the records. The bets were placed with quiet precision, like someone threading a needle in the dark. Bear Stearns stock was trading around $60 a share at the time. The options that were purchased were set to pay out if the stock fell below 30, then below 20, then whoever bought those contracts was not guessing. They were not being cautious. They were betting on near total collapse. And then the collapse came, exactly as the contracts predicted. The Securities and Exchange Commission opened an inquiry. They looked at the trading records. They tried to trace the money back to a name, a firm, a person sitting at a desk somewhere who had known what was coming. The inquiry went on for months, and then it quietly closed. No charges were filed. No names were made public. The trail went cold in the way that trails sometimes do when they lead somewhere uncomfortable. That is the first impossible detail. The second one is harder to explain. In the days before the crash really hit, before Lehman fell, and before the bailout talks began in earnest, there were phone calls. This is not a secret. The people involved have said so themselves in memoirs and in congressional testimony, and in long interviews given years later when the dust had settled. Hank Paulson, who was Treasury Secretary at the time, made dozens of calls. Timothy Geithner, who ran the New York Federal Reserve, made dozens more. Ben Bernanke was on the phone constantly. What those calls contained, specifically, who said what to whom, what was promised, and what was asked for in return, that part is not in the record. The calls were not logged in any way that became public. The notes that were taken, if notes were taken, were not released. Requests for records came back incomplete. Some calls happened on personal cell phones. Some happened in rooms where no staff were present. This is not unusual for powerful people in a crisis. You can say that. It's reasonable. When the world is falling apart, you don't stop to write everything down. But here is the thing that sits strange. The decisions that came out of those calls were enormous. Which banks would be saved? Which ones would be allowed to fail? Which firms would receive emergency funding? And which would be left to find their own way? These were decisions worth hundreds of billions of dollars. They reshaped the entire American financial system. They determined which institutions would survive and which would not. And the record of how those decisions were made is almost entirely missing. What we have are the outcomes. We can see who won and who lost. We can see which firms came out of the crisis larger than they went in. We can see which executives kept their jobs and their bonuses and their reputations. We can see which banks absorbed the ones that failed, growing wider and heavier like rivers after a flood. We just can't see the moment when it was decided. In folklore, there is a kind of story about a crossroads, a place where two paths meet in the dark, where a deal gets made that changes everything, and the only witnesses are the ones who made the deal. The story always ends the same way. Someone walks away with more than they came with, and nobody else ever quite figures out what was traded. The phone calls nobody wrote down feel like that crossroads. The meeting happened. The deal was made. And all we have left is the world it created. That world looks a certain way. We'll get to that. Some people will tell you it was just business. They'll say the crash was messy and ugly and painful. But it wasn't a plan. It was a pileup. 100 bad decisions made by 100 different people, all at once in the dark. And when Lehman Brothers fell on September 15th, 2008, those people will tell you it was simply the one domino that had to fall. The weakest link, the one that couldn't hold. And here's the thing, they're not wrong about everything. Lehman Brothers was in trouble, real trouble. They had loaded themselves up with mortgage-backed securities, like a man who can't stop eating even when he's sick. By the time that September morning arrived, they were carrying over $600 billion in debt. Their stock had lost nearly all its value. Their partners were pulling back. Their phones were ringing, and nobody on the other end had good news. By any honest measure, Lehman was a dying company. The skeptics point to this and say, see, no mystery here. A reckless firm made reckless bets. The market punished them. That's how it's supposed to work. And for a while, that argument holds up just fine. But then you start asking questions, and the questions don't stop, because Lehman wasn't the only one drowning. Bear Stearns had drowned 6 months earlier, in March of 2008, and the government threw Bear a rope. The Federal Reserve arranged a rescue. J.P. Morgan Chase bought Bear Stearns for next to nothing, but the deal came with a federal backstop, $30 billion of protection, paid for by the American taxpayer, to make sure the sale went through clean. Bear Stearns died, yes, but it died gently. It was caught before it hit the ground. Lehman got no such rope. The skeptics say that's because the situation was different. They say the Fed had used up its legal authority. They say Treasury Secretary Hank Paulson and Fed Chairman Ben Bernanke genuinely tried to find a buyer. Barclays, the big British bank, came close. Korea Development Bank circled for a while. Bank of America looked at the books, but nobody wanted to catch this one. And without a willing buyer, the government said its hands were tied. That's the official version. And it's told calmly with charts and footnotes. But here's what sits underneath it, quiet and stubborn. Hank Paulson had spent most of his career at Goldman Sachs. He ran that firm for years. He knew every player in this world by their first name. And Goldman Sachs, at the time Lehman was dying, held positions that would pay off if Lehman failed. Not just a little, enormously. The kind of payout that changes the shape of a company for a generation. The skeptics say that's a coincidence. They say Paulson had divested his Goldman holdings when he took the Treasury job. They say he was acting in the national interest, not his own. Maybe so. But then you look at who else was in the room. Timothy Geithner ran the New York Federal Reserve. He was on the phone all weekend as Lehman collapsed. He would later become Treasury Secretary himself. The men guiding the response to this crisis were the same men who had spent their careers building the system that created it. They knew where every dollar was buried. They knew which firms could survive a shock and which ones couldn't. They knew, better than anyone alive, exactly what letting Lehman fall would do. And they let it fall anyway. The skeptics say that's not evidence of a plan. They say it's evidence of panic, of men overwhelmed by a machine too big to understand. They say nobody engineered this. Nobody is that smart or that cold. That argument has weight. It really does. But the doubters go quiet when you ask them one simple thing. If the government truly had no choice, if its hands were truly tied, then why did it find billions of dollars for AIG the very next day? AIG, the insurance giant, whose collapse would have hurt Goldman Sachs more than almost any other firm on earth. AIG got $85 billion in federal money within 48 hours of Lehman's death. The rope appeared. It just appeared for someone else. The skeptics can explain Bear Stearns. They can explain the panic and the chaos and the bad math. But they have a harder time explaining that sequence. Lehman on Monday, AIG on Tuesday, one left to drown, one pulled from the water before it could go under. The gap between those two decisions is where the mystery lives. Some people watched Lehman fall and felt something cold settle in their chest. Not grief, not surprise, something closer to recognition, like they had seen this shape before in a dream they couldn't quite name. These were not conspiracy theorists. They were not people who wore tin foil hats or shouted on street corners. They were economists, former regulators, risk analysts who had spent 20 years inside the machine, people who understood the math and had read the memos and knew which phone calls happened on which days. And they all asked the same quiet question. Why Lehman? Why not the others? Bear Stearns had been saved in March. The government stepped in, arranged a buyer, made sure the walls didn't fall. 6 months later, Lehman Brothers was allowed to file for bankruptcy. The largest bankruptcy in American history. 150 years of business gone in a single September morning. The official answer was simple. There was no buyer. There was no legal authority. The Fed couldn't act. The Treasury couldn't act. Their hands were tied. But the people who know what they saw don't accept that answer. Not because they're angry, because they've done the math. Hank Paulson was the Treasury Secretary in September 2008. Before that, he was the CEO of Goldman Sachs. Goldman Sachs was one of Lehman's biggest competitors. When Lehman died, Goldman didn't mourn. Goldman absorbed the business that Lehman left behind. The clients, the talent, the market share. It all had to go somewhere. That's not a secret. That's public record. The believers just think it matters more than most people admit. There's a man named William Black. He was a bank regulator during the savings and loan crisis of the 1980s. He helped put over 1,000 bankers in prison back then. He watched 2008 happen, and he said plainly that what he saw was control fraud, not recklessness, not bad luck. Deliberate looting, dressed up in legal language. Black kept talking long after it was comfortable to talk. He gave interviews. He testified. He wrote papers. He didn't get rich from it. He didn't get famous in any way that helped him. He just kept saying what he saw. There were others like him. Sheila Bair ran the FDIC during the crisis. She sat in the rooms where the decisions were made. She wrote a book afterward, and in it, she described a culture where the big banks were treated as untouchable, where the people who were supposed to regulate them were more worried about upsetting them than protecting the public. She named names. She described conversations. She was calm about it, the way people are calm when they've made peace with something that once made them furious. Nomi Prinz spent years inside Goldman Sachs before she left and started writing about what she'd seen. She traced the money. She followed the relationships. She laid out in careful detail how the same small group of people cycled between the banks and the government and back again. How the decisions that shaped the crisis were made by people who all knew each other, who had all worked for each other, who all stood to gain from the same outcomes. None of these people were ignored because they were wrong. They were ignored because they were inconvenient. The question about Lehman keeps coming back to one specific moment. The weekend before the bankruptcy, there were negotiations. Barclays, the British bank, was willing to buy Lehman. The deal was close, and then it fell apart. The British regulators said no. They didn't want to import American risk onto British soil. But some of the people in that room have said, quietly, that the American side didn't fight very hard for the deal. That there was a certain willingness to let it go. A certain ease with the idea of Lehman simply disappearing. You can't prove intent from ease. You can't build a case on what someone didn't do, on the calls they didn't make, on the urgency they didn't show. The law doesn't work that way. But the believers aren't making a legal case. They're making a human one. They're saying that the people in that room had interests, that those interests shaped what they did and what they didn't do, that when a 150-year-old bank vanished in a single morning, somebody somewhere was not entirely sorry to see it go. The fog over that weekend has never fully lifted. The notes are incomplete. The memories are convenient, and the people who were there have mostly moved on to very comfortable lives. The ones who haven't moved on are still asking the same question. Why Lehman? Why not the others? There's a place in Lower Manhattan where the streets run narrow and crooked. They don't follow a grid. They follow old cow paths, old creek beds, old lines that men drew in the dirt 300 years ago. The buildings rise up tall on either side and block the sky. Even on a bright October morning, the light down there comes in thin and pale, like it has to fight to reach the ground. That is where the check was written. Not a paper check, of course. Nothing so simple. But in the fall of 2008, in those narrow streets, in those glass towers, the decision was made. The American government would pay. The American people would cover the debt. And the men who built the machine that broke would walk away whole. The number was $700 billion. That was the first number, the one they said out loud. Henry Paulson, the Treasury Secretary, had been the CEO of Goldman Sachs before he took that job. He stood before Congress in September of 2008 and asked for the money. He asked fast. He asked without much detail. The proposal he handed to lawmakers was 3 pages long. 3 pages to move $700 billion. Think about that for a moment. 3 pages. The bill that passed was longer. It had to be. Congress added conditions and language and oversight requirements. But the core of it stayed the same. The government would buy the bad assets, the toxic mortgage bonds, the poisoned paper that the banks had built and sold and bet against. The government would take it off their hands. The program was called TARP, the Troubled Asset Relief Program, a calm name for a wild thing. And here is where the land remembers, because there is something about the physical world of that moment that people who lived through it still carry in their bodies. The air that fall had a particular quality, heavy and gray and still, like the sky itself was holding its breath. People in cities across the country walked to work and felt something wrong without being able to name it. The ordinary world had cracked somewhere underneath, and everyone could feel the shift, even if they couldn't see it. In small towns in Ohio and Michigan and Nevada, The foreclosure signs were going up like crops. Pale rectangles staked into front lawns. One on a street, then two, then five. The grass still green. The flower boxes still painted, but the family's gone. The windows dark. The mail piling up behind the slot in the door. The land holds that. The neighborhoods that emptied out in 2008 and 2009 never fully came back. You can drive through parts of Detroit or Cleveland or the outer suburbs of Las Vegas today and still feel it. Houses with soft roof lines, driveways cracked and sprouting weeds through the seams, trees that grew up through old carports, nature moving back in where people moved out. That is what the bailout did not address. It steadied the banks. It did not steady the streets. Paulson and Ben Bernanke, the Federal Reserve Chairman, made the rounds. They met with congressional leaders in private. They described what would happen if the money wasn't approved. Banks would fail. Credit would freeze. Paychecks wouldn't clear. Grocery stores wouldn't be able to restock their shelves. The story they told was of a total collapse, a darkness spreading out from Wall Street into every corner of the country. Maybe that was true. Maybe it wasn't. The honest answer is that nobody knows for certain what would have happened, because it didn't happen. The money was approved. The banks were saved. And the men who had built the machine went back to work. Some of them collected bonuses that same year. The year of the bailout. The year the check was written by people who had nothing to do with any of it. There is a river that runs along the southern edge of Manhattan. The Hudson, wide and dark and cold in October. It has been there longer than the city, longer than the country. It ran past this island when the only people here were the ones who had always been here. It will run past it long after the glass towers are gone. The river doesn't remember the names. It doesn't remember Goldman Sachs or Lehman Brothers or the 3-page proposal or the $700 billion. It just keeps moving, slow and gray and steady, carrying whatever falls into it out toward the open sea. The land remembers in its own way, quietly, without judgment. The empty houses, the cracked driveways, the pale signs staked into the grass. That is the record it keeps. $700 billion. Say that number slowly. Let it sit in your mouth for a moment. $700 billion. That's more money than most countries make in a year. And in the fall of 2008, Congress handed it over in about 2 weeks. The official name was the Troubled Asset Relief Program. TARP, a clean, forgettable word for something enormous. The idea was simple, at least on paper. The government would buy the bad assets sitting on bank balance sheets. The toxic mortgages, the poisoned bonds. It would take the garbage off their hands, and the banks would start lending again. America would breathe. The crisis would pass. That was the story. Now here's what actually happened to the money. The banks took it. They held it. They paid their executives. J.P. Morgan Chase got $25 billion and handed out billions in bonuses that same year. Goldman Sachs got $10 billion and paid out nearly $5 billion in compensation to its people. Citigroup got $45 billion, the biggest slice of all, and its stock kept falling anyway. The money went in. The lending didn't come back out, not to small businesses, not to families, not the way anyone had promised. And here's the part that feels familiar if you've been paying attention. Because this wasn't the first time something like this happened in America. Not even close. Go back to 1989. The savings and loan crisis. $320 billion in losses. Over 1,000 banks failed. The government stepped in with a bailout of its own through something called the Resolution Trust Corporation. Taxpayers covered most of it. Some bankers went to prison. Not many, but some. The ones who committed fraud, who cooked the books, who made loans they knew would never be repaid. A few of them actually faced consequences. About 800 people were convicted. People remembered that. People talked about it. And when 2008 came around, a lot of those same people expected the same thing to happen again. It didn't. Go back further. 1907. A banking panic that nearly swallowed New York whole. J.P. Morgan himself, the original one, sat in his library on Madison Avenue and essentially ran the rescue operation out of his own pocket. He called the other bankers in. He told them what to do. He decided who got saved and who didn't. One man in one room with no government authority at all, made the decisions that stopped the collapse. People marveled at it. They also feared it. Because what kind of country lets one private citizen hold that much power over its money? That panic, by the way, is exactly what the Federal Reserve was created to prevent. 6 years later, in 1913, Congress built a central bank so that no single man would ever again have that kind of control. The power would belong to an institution, something permanent, something accountable. And yet in 2008, a small group of men in private meetings made the same kinds of decisions Morgan made in 1907. Who lives? Who dies? Who gets the phone call on a Sunday night? The pattern keeps showing up. Different decades, different names on the door, same shape underneath. There's a story people tell about the panic of 1837. Andrew Jackson had just killed the second bank of the United States. He hated central banks. He thought they were tools of the wealthy used to drain ordinary people dry. When the bank died, credit dried up with it. Businesses failed. Unemployment spread across the country like frost across a field in October. People lost farms, lost homes, lost everything they'd spent a lifetime building. Jackson believed he was protecting regular Americans from the bankers. Some historians think he was right. Some think he made it worse. But the thing that stays with you is this. The argument he was making in 1837 is the same argument people were making in 2008. That the system was rigged. That the money always flowed upward. That the people who caused the damage never paid the price. That argument is older than the Federal Reserve, older than the income tax, older than the Civil War. It runs through American history like a river under the ground, invisible most of the time, but always moving. $700 billion went out the door in 2008. Some of it came back, eventually. The government actually turned a profit on parts of TARP, at least on paper. But the question people kept asking wasn't whether the money came back to Washington. It was whether it ever reached the people who needed it most. The answer to that one was quieter, and it took a lot longer to arrive. Here is what the wreckage left behind. Not ash, trouble. Not the kind of ruin you can photograph and put in a newspaper. The crash of 2008 left behind something stranger than that. It left behind winners, big ones, and the evidence is sitting right there in plain sight, like a letter tucked inside a book you weren't supposed to find. When the dust settled, the American banking system had fewer banks than it started with. That sounds simple. It isn't. Think about what that means. A catastrophe hit. Millions of people lost their homes. Trillions of dollars vanished from the economy like smoke off a cold morning lake. And when it was over, the men who ran the biggest banks were sitting on more than they had before. That's the artifact. That's the thing you can hold in your hand. J.P. Morgan Chase came out of the crisis owning Bear Stearns and Washington Mutual. Bear Stearns, as you know by now, fell on a Sunday in March of 2008. J.P. Morgan bought it for $2 a share. $2. A company that had been worth $60 a share just 12 months before. The Federal Reserve backed the deal with $29 billion in guarantees. J.P. Morgan took the assets. The government took the risk. Then Washington Mutual went down in September. It was the largest bank failure in American history. J.P. Morgan bought it out of FDIC receivership for $1.9 billion. Washington Mutual had over $300 billion in assets. J.P. Morgan paid less than $2 billion for the keys to that kingdom. Bank of America did the same thing. They absorbed Countrywide Financial, the mortgage lender that had handed out more bad loans than almost anyone. They bought it in January of 2008 for $4 billion. Countrywide had written hundreds of billions in mortgages. Some of those mortgages were poison, but some of them were real. Bank of America got both. Then, in September of that same year, they bought Merrill Lynch, one of the oldest investment banks in America. Gone, folded into Bank of America over a single weekend. Wells Fargo took Wachovia. Wachovia was the fourth largest bank in the country. It had been around since before the Civil War in one form or another. Wells Fargo got it for about $15 billion. Wachovia had over $800 billion in assets. You can look all of this up. These are not rumors. These are not whispers passed between strangers at a diner counter. These are press releases, annual reports, SEC filings. The paper trail is wide and well lit, and it leads to the same place every time. The big got bigger. The small disappeared. In 1990, the 10 largest banks in America held about 10% of all deposits in the country. By 2008, before the crash, that number had grown to 50%. After the crash, after the buyouts and the bailouts and the emergency mergers, it climbed higher still. Today, the 4 largest banks in America hold assets worth more than the bottom 4,000 banks combined. That shift didn't happen by accident. It happened through acquisition, through crisis, through the quiet transfer of broken institutions into the hands of the ones who were still standing. There's a photograph you can find from late 2008. It shows the lobby of a Washington Mutual branch on the day it closed. The tellers are gone. The lights are still on. A few customers stand at the door looking in through the glass, hands pressed against it like children at a toy store window. The sign still says Washington Mutual, but the bank is already gone. That image is the artifact. That lobby, empty and lit, and still branded with a name that no longer meant anything, is what the crash looked like from the ground. The men who engineered these purchases knew what they were doing. You don't buy a $300 billion bank for $2 billion by accident. You don't absorb a century-old investment house over a single weekend without having thought about it before. These deals moved fast because the people making them had been watching and waiting and knowing. The crisis was the door. The acquisitions were the walkthrough. And here's the thing about artifacts. They don't lie. A letter can be forged. A memory can fade. But a balance sheet is a balance sheet. The numbers are the numbers. J.P. Morgan in 2006 and J.P. Morgan in 2010 are not the same institution. They are not even close to the same size. Something happened in between. Something that looked like disaster from the outside. Something that looked very different from the inside. The banks came out bigger. That part is not a theory. That part is just true. While the banks counted their bailout money, Regular people were standing in their driveways, staring at houses they no longer owned, holding cardboard boxes full of picture frames and kitchen things. The autumn air was cold and sharp. The leaves were turning orange and red, the way they always do, like nothing had happened at all. There was a woman in Cleveland named Sandra. Her neighbors still talk about her. She had worked 30 years as a school nurse, 30 years of small paychecks and careful saving. She bought her house in 2004, a little brick place on a quiet street with a maple tree out front that went gold every October. She was told the loan was a good one. She was told the payments would stay low. They didn't. By 2009, her payments had nearly doubled. The bank that gave her the loan had already sold it twice. She didn't even know who owned her mortgage anymore. She called a number, got a recording, called again, got someone in another state who had never heard of her street. She sent letters. The letters went nowhere. The maple tree went gold one more time. Then she was gone. Stories like Sandra's spread across the country like smoke after a fire. In Phoenix, a retired electrician named Gerald had put his life savings into a second home. He was going to rent it out, supplement his pension, leave something for his kids. The market collapsed before he found a single tenant. He lost both properties inside of 18 months. His kids got nothing. Gerald still doesn't talk about it much, but his daughter does. She talks about it every Thanksgiving. That's how these stories travel, not through newspapers, through families, through the way a father goes quiet when a certain year gets mentioned, through the way a grandmother changes the subject when someone brings up the old neighborhood. The details shift a little with each telling, but the shape of the loss stays the same. In Detroit, whole blocks emptied out. Houses sat open like wounds. Copper pipes got stripped. Windows got broken. Grass grew up through cracked driveways. Cities that had already been struggling found themselves buried under a new kind of weight. The tax base dried up. Schools lost funding. Firehouses closed. The damage moved through a community the way water moves through old wood, slow and quiet and total. A man named Darnell grew up in one of those neighborhoods. He was 12 years old in 2008. He remembers the summer his block went from full to half empty in about 6 months. He remembers the plywood on the windows, the way the street got darker at night because nobody was paying the electric bill inside those houses anymore. He grew up and became a housing advocate. He still uses the word theft when he talks about what happened to his neighborhood. The numbers are hard to hold in your head. About 10 million families lost their homes between 2006 and 2014. 10 million. That's more people than live in the state of Michigan. Each one of those families had a story, a specific house, a specific tree in the yard, a specific drawer in the kitchen where they kept the takeout menus and the spare batteries. All of it gone. And here is the part that the families still talk about, still shake their heads over, still can't quite make sense of. The same banks that sold them the bad loans got the bailout money. The same institutions that packaged up the poison and sold it as medicine got to keep their buildings and their bonuses and their names on the sides of skyscrapers. The people who lost the houses got a government program that was supposed to help them. Most of them never saw a dollar of it. The program was called HAMP, the Home Affordable Modification Program. It was supposed to help homeowners renegotiate their loans, stay in their houses, keep their lives from falling apart. The government set aside $75 billion for it. By the time it ended, only about 900,000 people had gotten permanent help. The rest were denied, delayed, or lost in paperwork so thick it felt like it was designed to exhaust them. Some of them did get exhausted. They gave up. They moved in with family. They rented small apartments in towns they didn't know. They started over from nothing in their 50s and 60s, at an age when starting over is not supposed to be part of the plan. The banks came out bigger. The executives kept their bonuses. The families kept the memory. That's the trade that got made in the years after the crash. And the families at those holiday tables, they haven't forgotten the terms. There were people whose whole job was to watch. Not soldiers, not spies, just men and women in office buildings with fluorescent lights and gray carpet. People with titles like Chief Examiner and Director of Supervision. People who got up every morning drove to work and sat in rooms full of paper. Their job was simple: watch the banks, make sure nothing went wrong. They watched, and nothing went wrong. Officially, the Office of the Controller of the Currency, the Office of Thrift Supervision, the Securities and Exchange Commission, the Federal Reserve itself. These weren't small operations. They had thousands of employees. They had subpoena power. They had the legal right to walk into any bank in America and demand to see every document in every drawer. They had all of that. And still, the machine kept running. Some people say the regulators were fooled, that the products were so complex, so layered, so deliberately tangled that even trained examiners couldn't see what was inside them. That's probably true, at least partly. The collateralized debt obligations, the synthetic instruments, the credit default swaps. These things were built to be hard to understand. That was part of the design. But some of what happened wasn't complicated at all. The FBI sent a report to Congress in 2004, 4 years before the crash. They called it an epidemic of mortgage fraud. They said it was growing fast. They said it would cause serious damage if nobody stopped it. The report sat there. The resources to act on it never came. The epidemic kept spreading, quiet as smoke through a closed room. The Office of Thrift Supervision was supposed to oversee savings institutions. The thrifts, the smaller banks and lenders that were handing out mortgages like candy at a parade. Indy Mac was one of them. Washington Mutual was another. Both of them collapsed in 2008. Both of them had been examined. Both of them had been found, in official language, to be operating in a satisfactory manner not long before they fell. Satisfactory. That word is worth sitting with for a moment. The SEC had a program called the Consolidated Supervised Entities Program. It was voluntary. The big investment banks, Bear Stearns, Lehman Brothers, Merrill Lynch, Goldman Sachs, Morgan Stanley, they could sign up and let the SEC keep an eye on their risk levels. In 2004, the SEC changed the rules and let those banks carry far more debt relative to their assets. The leverage limits went up. The cushion got thinner. By 2008, Some of those banks were carrying $30 of debt for every $1 they actually owned. 30 to 1. A single bad wind could knock that over. And it did. The SEC's own Inspector General later looked into what happened at Bear Stearns. The report was not kind. It found that examiners had identified problems and hadn't followed up. That warning signs had been noted and then set aside. That the supervision had been, in the Inspector General's careful language, inadequate. Inadequate. Another soft word for a hard thing. Now, here's where the story gets quieter and more complicated. Some people look at all of this and see corruption. Regulators who were paid off, or promised jobs later, or simply told by their bosses to leave the banks alone. And there's some evidence for that. The revolving door between the agencies and the banks was real. People moved back and forth. A man who spent 5 years at Goldman Sachs might spend the next 5 years at the Treasury Department and then go back to Goldman. That happened. It kept happening. But other people look at the same facts and see something sadder. They see agencies that had been slowly starved of funding and staff for years. They see examiners who were outgunned, outpaid, and overwhelmed. They see a culture that had been told over and over that the market knew best, that the banks were sophisticated, that the smart money didn't need a babysitter. Both things can be true at the same time. What's harder to argue with is the outcome. The watching didn't work. The warnings didn't land. The systems built to catch exactly this kind of problem did not catch it. And when the dust settled, nobody at the regulatory agencies lost their jobs over it. Nobody was prosecuted. Nobody sat before a judge and answered for what they missed. The gray carpet offices kept their lights on. The titles stayed the same. The people who were supposed to be watching went back to watching. And somewhere in that fact, quiet as it is, there's a question that doesn't go away easy. Picture yourself standing on Wall Street at 2 in the morning. The street is empty. The buildings rise up on both sides like canyon walls, dark glass and old stone, climbing so high they seem to lean toward each other at the top. The sky between them is a thin strip of deep blue-black, and a few stars manage to push through the city glow. many, just enough to remind you the sky is still up there. The air is cold. It smells like rain that already fell, like wet concrete and something metallic, like the city has been breathing all day. And this is the exhale. Your footsteps echo. There is no one else here. The taxis are gone. The traders are home. The lights in the towers above you burn orange and white, floor after floor. Even now, even at this hour, somebody is always awake in these buildings. You stop in front of the New York Stock Exchange. The columns are wide and white, pale as bone in the lamplight. The American flag hangs still above the entrance. There is no wind tonight. Everything is quiet in a way that feels almost formal, like the silence is dressed up, like it knows where it is. This is where the crash happened. Not in one room, not on one day, but here in this neighborhood, in these buildings, in the offices stacked 40 stories above your head. The decisions were made. The papers were signed. The bets were placed. And then, when it all came down, when the smoke cleared and the numbers settled, something strange happened. Nobody went to prison. Think about that for a moment. The largest financial collapse since the Great Depression. 8 million jobs gone. Millions of families losing their homes. Trillions of dollars in wealth just gone, like smoke off a dying fire. And when the Justice Department opened its files, when the investigators put on their suits and sharpened their pencils, the prosecutions that everyone expected never came. The Department of Justice announced a task force in 2012. It had a serious name. It had serious people attached to it. Attorney General Eric Holder stood at a podium and made serious promises. The task force met. It issued reports. And then, quietly, without much announcement, it dissolved. The cases it was supposed to build were never built. One former federal prosecutor later said the government had simply decided the banks were too big to jail, not too big to fail, too big to jail. That the damage of prosecuting a major institution, the chaos it might cause, the jobs it might cost, was too great a risk. So the risk was passed, like it always was, to the people at the bottom. The street is still around you. A piece of paper skitters across the cobblestones, pushed by a small, cold gust. spins once and stops against the base of a lamppost. The light above it flickers just once and holds. There were civil settlements. Banks paid fines. J.P. Morgan Chase paid $13 billion. Bank of America paid nearly $17 billion. The numbers were enormous. They were also, for institutions that size, manageable. No executive signed a confession. No one admitted to a crime. The money moved from one column to another, and the men who ran the banks went home to their houses and their families and their lives. Phil Angelides chaired the Financial Crisis Inquiry Commission. His panel spent 2 years reviewing millions of documents and interviewing hundreds of witnesses. They concluded that the crisis was avoidable, that it was the result of human action and inaction, that specific people made specific choices that caused specific harm. The report named names. It made referrals. The referrals went to the Justice Department. The Justice Department did not act on them. The stars above Wall Street are faint tonight. The buildings block most of them. But tilt your head back and look up through that narrow strip of sky, and you can find 1 or 2 burning steady up there, cold and clear and indifferent to everything happening below. There is a word people use for moments like this: accountability. It means someone answers for what they did. It means the weight of a thing lands on the person who set it in motion. It is a simple idea. It is as old as the idea of justice itself. The columns of the stock exchange are still white in the lamplight. The flag hangs still. The buildings hum with electricity and climate control, and the soft sound of servers running through the night. The street is empty. The silence is thick as wool. And somewhere above you, the lights are still on. There is a door in Washington. You can't see it on any map. No tourist ever photographs it. But people who work in government know exactly where it is. And they know exactly how it swings. It swings one way when a man leaves the Treasury Department and walks into a corner office on Wall Street. It swings the other way when a bank executive steps out of a black car and into a Senate hearing room. It has been swinging like that for decades. But after 2008, it started spinning so fast you could barely see the faces anymore. This is what people call the revolving door, and it is not a metaphor. It is a real pattern with real names and real dollar amounts attached to those names. Robert Rubin served as Treasury Secretary under Bill Clinton. He helped push through the repeal of Glass-Steagall in 1999. Then he walked straight into Citigroup and collected over $100 million in pay over the next decade. Citigroup was one of the banks that needed a bailout in 2008. Rubin left before the crash. He left with the money. Henry Paulson ran Goldman Sachs for years. Then he became Treasury Secretary under George W. Bush. He was the man who stood at the podium and told the country it needed to hand $700 billion to the banks. Goldman Sachs received $10 billion of that money. Paulson had sold his Goldman stock before taking the government job. He paid no capital gains tax on it because of a rule that protects government officials. He walked away clean. Timothy Geithner ran the New York Federal Reserve during the crash. Then he became Treasury Secretary under Barack Obama. He oversaw the recovery. He made sure the banks were whole. Then he left government and went to work for a private equity firm called Warburg Pincus. That firm manages money for some of the same financial institutions Geithner had regulated. These are not accusations. These are the public records. These are the facts that anyone can find if they look. And yet somehow, most people never heard them laid out in a row like this. The people who built the machine, ran the machine, crashed the machine, and then fixed the machine with public money, all ended up in roughly the same place. Comfortable, employed, connected. The machine kept running. There is a word for this kind of arrangement. Economists call it regulatory capture. It means the agencies meant to watch over an industry end up being run by people from that industry. The watchers become the watched. The watched become the watchers. After a while, nobody can tell the difference. After 2008, something shifted in the way ordinary Americans thought about their government. Not all at once. More like a slow frost settling over a field at night. You don't see it happen, but in the morning, everything looks different. People started to feel that the system was not broken. That that it was working exactly as designed, that the design just didn't include them. That feeling spread. It moved from kitchen tables to town halls to the internet. It moved into politics. It moved into the way people talked about banks, about taxes, about who gets protected when things go wrong. The crash became a kind of shared wound, and like most wounds, it left a scar. You can see that scar in the way people vote now, in the way they talk about institutions, in the deep, quiet suspicion that sits behind the eyes of anyone who lost a house or a job or a retirement account in those years, and watched the people responsible walk away with bonuses. That suspicion is not paranoia. It is pattern recognition. It is what happens when people watch the same story play out enough times that they start to see the shape of it. The revolving door kept spinning after 2008. It spins today. New names, same motion. People leave agencies and go to the firms they once regulated. People leave firms and go to the agencies that will regulate their former employers. The salaries on the private side are always larger. The memory of where you came from never fully disappears. There is an old saying in Washington. It goes something like this: there are no permanent enemies, only permanent interests. The men who built the machine believed that. They lived by it. And when the machine broke and the country paid to fix it, those interests were protected first. The rest of the country got in line. The door kept swinging. It is swinging right now. Somewhere tonight, it is swinging. There was a man named Alan Grayson who used to sit in a hearing room in Washington and ask questions nobody else would ask. He was a congressman from Florida. He wore plain suits. He had the kind of face that looked like it had been up too late reading things it wasn't supposed to read. And in the spring of 2009, he sat across from a Federal Reserve official named Elizabeth Coleman and asked her something simple. He asked her where the money went. Not the bailout money, not the TARP funds that everyone was already arguing about. He was asking about something else, something quieter, something that had moved through the dark like water through old pipes. He was asking about the Federal Reserve's own emergency lending programs. Coleman was the Inspector General of of the Federal Reserve. Her job was to watch the watchers, to make sure the people holding the money were holding it right. Grayson leaned forward and asked her if she knew who had received trillions of dollars in emergency loans from the Fed during the crisis. She said she didn't know. He asked if her office was investigating it. She said it wasn't. He asked if she knew what had happened to $1.5 trillion in securities the Fed had taken onto its own books. She said she didn't know that either. The room was quiet, not the quiet of a place where nothing is happening. The quiet of a place where something enormous has already happened and everyone is pretending it hasn't. Grayson took that moment and carried it with him. He left Washington eventually, lost his seat, won it back, lost it again. But he kept talking about what he had seen in that room. He took it to interviews, to podcasts, to small auditoriums in cities where people came out on weeknights to sit in folding chairs and listen to someone tell them the truth. He became a kind of wanderer with a story in his pocket. And the story was this. While Congress was arguing about $700 billion in public bailout money, the Federal Reserve was doing something else entirely. Quietly, without a vote, without a headline, the Fed had opened what it called emergency lending facilities. Special windows where banks could bring their broken assets and swap them for cash. No public announcement. No congressional approval required. The Fed had the legal authority to do this on its own, and it did. Later, through a provision buried in the Dodd-Frank financial reform law, Congress forced the Fed to disclose what it had done. The numbers came out in 2011. They were hard to look at directly, the way you can't quite look directly at the sun. The total came to somewhere around $16 trillion. Some counts said more. The money had gone to American banks, but it had also gone to foreign banks. Deutsche Bank, Barclays, the Royal Bank of Scotland, banks in France and Switzerland and Japan. All of them had come to the Federal Reserve's quiet window and walked away with American dollars, backed by American taxpayers who never knew the transaction had happened. The interest rates on these loans were low, sometimes nearly zero. The banks borrowed cheap, stabilized themselves, and then went back to business. The people who lost their homes in Ohio and Nevada and Michigan did not get 0% loans. Grayson used to say that out loud at those folding chair meetings. He'd let it sit there in the air for a moment. He wasn't angry when he said it. He said it the way you'd say something that has stopped surprising you, but still deserves to be said. The Federal Reserve is not a government agency in the way most people picture. It is a strange hybrid thing, part public, part private. Its board is appointed by the president, but its regional banks are owned by the commercial banks they regulate. The people being watched have a hand in choosing the watchers. Grayson carried that detail too. He carried all of it. He'd grown up in public housing in New York. He'd worked his way through school. He understood what it meant to count dollars carefully. And he had sat in a room and watched a woman whose job was oversight tell him, under oath, that she had no idea where trillions of dollars had gone. That's the story he took with him when he left Washington. He planted it in every room he walked into. Some stories travel that way, not in books, not in newspapers, in the mouths of people who can't stop talking about what they saw. Before 2008, there were roughly 8,000 banks in America. Small ones, local ones, the kind where the manager knew your name and your father's name, and probably your grandfather's too. Banks that had grown up alongside their towns, that had financed the hardware store on the corner and the farm out past the ridge. Banks that were, in some old and honest way, part of the community they served. After 2008, those numbers started to fall, and they kept falling, and they are still falling today. What rose in their place were fewer names, bigger names, names that now appear on buildings in every city, on every corner, in every state. Names that were already large before the crisis and came out the other side enormous. J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup. These four institutions now hold roughly half of all the deposits in the United States. Half of everything. Think about what that means for a moment. Not in an abstract way. Think about it the way you'd think about a town where one family owns the grocery store, the gas station, the hardware shop, and the only bank. Think about what it means to need something from someone who has no competition. Think about what happens to prices, to choices, to the quiet leverage that comes from being the only game in town, except the town is an entire country. The crisis didn't just redistribute wealth, it redistributed power. And power, once it moves, rarely moves back. There's a word for what happened: consolidation. It sounds clean and administrative, like something that happens in a boardroom with a whiteboard and a cup of coffee. But consolidation at this scale is something older and stranger than that. It's the story of rivers, how 100 small streams over time find their way into fewer and fewer channels until all that water is moving in one direction, controlled by whoever stands at the mouth. The men who ran the surviving banks didn't just survive the flood. They used it. They bought the failing institutions at prices that would have been impossible in any other moment. Washington Mutual went to J.P. Morgan Chase for a fraction of what it was worth. Wachovia went to Wells Fargo. Merrill Lynch went to Bank of America. Each of these was a massive institution. Each of them vanished into something larger. Each acquisition made the buyer harder to challenge, harder to regulate, harder to imagine failing. Too big to fail had been a warning. It became a business model, and here is where the mystery opens up, wide and quiet, like a field at the edge of a forest where the light changes, and you're not quite sure what's standing in the trees. If you believed this was all an accident, then the consolidation is a sad coincidence, a market correction, the natural result of bad decisions made by too many people at once. The big banks got bigger because they were better managed, or luckier, or both. And the small banks disappeared because that's what happens when the tide goes out. Nobody planned it. Nobody needed to. It just happened. But if you believed something else, then the consolidation looks different. It looks like the point. It looks like the reason the machine was built the way it was built, wound up the way it was wound up, and allowed to run the way it ran. Not a collapse, a transfer, a slow and deliberate movement of assets, of customers, of power, from many hands into fewer ones. The men who engineered that transfer, if they engineered it, are not in prison. They are on boards. They They are at conferences. They give speeches about financial stability and responsible lending. They are, by any visible measure, respected. And the institutions they built or saved or acquired are larger now than they were before the crisis they either caused or survived or both. That's the part that sits with people. That's the part that doesn't resolve. Because in most stories, the ending tells you something. The villain is caught. The hero is rewarded. The mystery is solved, and the world returns to the shape it had before. But this story doesn't do that. This story ends with the same men in the same rooms making the same decisions. Except now, there are fewer rooms and fewer men, and the decisions affect more people than ever before. The small banks are mostly gone. The local names are mostly gone. What's left is enormous and quiet and very, very stable. And somewhere in that stability, in that smooth and untroubled surface, there is a question that nobody has answered. Not really. Not in a way that closes the door. The question is simple. It always has been. Was this the result? Or was this the plan? The fire is low now. The embers are orange and soft, like something breathing in the dark. The story is told, but you already know it doesn't end here. That's the thing about this particular mystery. It doesn't have a clean edge. There's no door that closes. There's no moment where someone stands up and says, "This is finished. Justice was done. You can rest now." The old-timers know that. The ones who watched it happen, who felt the ground shift under their feet in 2008, who lost a house or a job or a retirement they'd spent 30 years building. They know the story kept moving long after the news cameras went away. And here's what keeps them up at night. Not the crash itself, not the fear they felt in those weeks when the whole system seemed to teeter on the edge of something no one could name. What keeps them up is the quiet that came after, the way things settled back into place, the way the same names reappeared at the same tables, the way the banks grew larger, the bonuses came back, the regulators went through the revolving door one more time, and the world looked almost exactly like it had before, except that fewer people owned more of it. The old-timers remember a different kind of America, not a perfect one, not a golden age that never had its shadows, one where the distance between the top and the bottom felt like something a person could cross, where a factory worker could own a house, where a small bank in a small town made decisions based on whether it knew your family. That world didn't vanish in 2008. It had been fading for a long time. But 2008 was the moment the fading became undeniable. The stars are out now, thick and white above the tree line. The pine trees stand still in the cold air. There's no wind tonight. Just the soft sound of the world settling into itself, the way it does in the deep hours when most people are asleep. Some people look at what happened and see a conspiracy. A group of men in a room, drawing lines on a map, deciding who would win and who would lose. And maybe there's something to that. The phone calls that weren't written down, the meetings that happened on weekends, the way certain institutions were saved, and one was allowed to fall. And no one has ever given a fully satisfying answer for why. But other people look at the same story and see something older and simpler. They see power doing what power has always done, protecting itself, expanding itself, finding the cracks in the rules and moving through them, not because anyone sat down and planned the whole thing from the beginning, but because systems built by powerful people tend to serve powerful people. That's not a mystery. That's just how it works. The mystery is that we keep being surprised by it. The mystery is that the story gets told and retold, and still the same patterns repeat. Still, the same doors revolve. Still, the same names appear on the same committees. And still, somewhere in a house that used to belong to someone else, a family is figuring out how to start over. That's what the old-timers carry. Not bitterness, exactly. Something more like a long, tired knowing. A feeling that they saw something true about the world and couldn't unsee it. That the curtain moved just for a moment, and what was behind it wasn't monstrous. It was just ordinary. Men making choices that benefited themselves. Systems running the way they were designed to run. And the rest of the country absorbing the cost. The embers are nearly gone now. Just a faint red glow at the center, like a heartbeat slowing down. The air smells like wood smoke and cold pine, and the particular stillness that only comes after midnight. The kind of quiet that feels like the world is holding its breath. You can close your eyes now. The story is as finished as it's going to get. These things don't resolve. They accumulate. They get passed down the way all the old stories do, from the people who lived them to the people who need to know. And knowing is not nothing. Knowing is, in fact, the only place any of this ever changes. The stars are still out. The trees are still standing. The night is deep and wide, and full of a silence that feels almost kind. Subscribe for a brand new mystery every night. One tap, and a new story is waiting for you tomorrow. Sleep well.